morning, everyone, and welcome back to day 2 of the Investable Showcase 2021. Thank you all for joining us again this morning. I hope you all enjoyed yesterday's sessions, the panels and presentations, and the masterclasses, as well as had plenty of meetings and, of course, viewed the company showcases in the virtual event platform. Lots more happening today. We'll shortly be kicking off with our keynote presentation, which, as you can see, titled State of the State with Bar-Nahum with Jefferies. Following this, we have our panel on perspectives on risk and reward within the life sciences industry, again featuring Gil and a number of experts discussing that, followed by masterclasses on M&A, partnering and licensing, before rounding off with a bit of a US focus with a number of some of the funds I think are going to be mentioned in this presentation this morning, discussing the US healthcare investment landscape, and followed on by a presentation from the Iowa Economic Development Group. But for now, as is traditional with the Investable Showcase, and a huge thank you to Jefferies as our partners for the event. I'm delighted to hand over to Gil Bar-Nahum with Jefferies, who's going to be guiding us through our keynote this morning. So Gil, over to you.
Thanks, Josh, and really great to continue our partnership with you and the LSX team. Good morning, everyone. Excited to be providing you the, consistent state of the state in a similar format that we've been doing it over the last several years here at the LSX conference. So let's just jump into it. Today, what we'll talk about is kind of what's going on in the markets, what's going on with the IPO space, how has the M&A landscape evolved, what's new in the SPAC space. The presentation should last around 30 minutes, and then we'll open it up for about 10 minutes of questions. So if there are any, please do shoot them through the portal. So let's get on to the first slide and take a look at the U.S. equity market indexes. Clearly, it's been quite a challenging year. As you can see, mid-February, we really hit a peak in that blue line there, which highlights the overall XBI. And since then, it's been an absolute slide in an extremely difficult market throughout the summer and throughout September, and just as recent as last week. Extremely difficult to get transactions over the goal line. Things are being downsized. Valuations have come down pretty significantly. And have we seen a bottom? I think we are seeing some pea shoots of recovery with respect to what the biotech index had done last week, up about 5 or 6%. But this week has been, again, a bit of a challenge. And in the context of the rest of the overall market, you see it all seems to be chugging along just fine. It's really just the biotech index, so to speak, and the therapeutic development companies that I think have really, really underperformed. And there's a number of reasons for that. We can walk through that today. As we look at the overall technology consumer and XBI indexes down at the bottom, again, you can see that while there has been some decent performance in the other indexes of late, this year has been a real challenge for a number of the investors in all three indices. Notwithstanding that, I think what we've seen over the last couple of years is healthcare has been an absolute rocket ship. And maybe if we flip to the next slide, I think that really accentuates last year versus this year. And you can take a look at the 2000 index, the Russell 2000 over the 2020 and the 2021 segment here on the top part of the slide. You can see healthcare 45% overall in terms of 2020 performance, and really an inversion of that slide down 10%, where energy, consumer, and financial services have really come back to the top. A lot of this is a bit of the reopening trade, right? As biotech came into the spotlight, vaccines, and folks started to diversify away from hotels, consumers, the Gap, whatever it was that they were owning. They put a lot of that retail money into healthcare and biotech. A lot of that started to run, and that created a really boisterous market over the last 18 months. But as February hit, we really hit a bit of a hold. Most of the IPO transactions, more than half of the year, happened in the first 2 months of the year. And since then, as you can see over the summer, really, really quiet. And as we think about new issuance in biotech all the way down at the bottom, well, there have been a few deals over the last few weeks. As I mentioned, they have been relatively challenging. And it's not in the context of volatility, but just in the context, I think, of overall pool performance. And I think the next slide will really accentuate that as well. What we've done over the last several years is try to take a look at how many IPOs do we have this year versus last year. Over the last several years, where were we last year versus this year? You can see 70 at this time last year versus 80 in 2021. And you think, well, if the market's so challenging, how are we at 80 deals? Remember, more than half of those were in the first 2 months of the year. But what you can also see, I think, is if you take a look at the offer to year end, offer to 1 day, there's a significant difference in the overall performance. The valuations, I think are a little bit up, but in the context of deal sizes, things have come down pretty significantly. And the old, oh, I can make a significant return by playing this biotech IPO game, that's become much more challenging. And in the context of that 7.8%, there are a significant number of companies that have really, really underperformed as investors have, taken shelter and moved out of that. A lot of that also impacts the overall pricing performance. And as you see, what was the percentage of above and below the range this year versus last year? We certainly did have some good in the range situations, but not like we did in 2020. And if you look over the last, let's say, couple of months into this year and back into the summer onto the next slide, you can see that a significant portion of them were either, all of them necessarily in the range in terms of going above the range. We've seen that very, very rarely over the last couple of months. And also performance over the last couple of weeks has also been quite spotty. What we've seen is a number of these IPOs have come back. What you've seen as their performance really, really was positive in the first few days. There was some profit taking, highlighting again that a lot of the portfolio managers this year have had quite of a challenge, and a lot of them are finishing the year thinking about, how do I invest any money to try to change my overall profile? I'm down. Do I really want to take another risk? And if I can't be very, very confident that I'm going to make money on this overall position by the end of the year, I'm just going to sit on the sidelines. And that's the overall mentality that we're seeing. And I think, again, like a lot of that has to do with the overall performance. If you take a look on the next slide, the aftermarket performance is still, quite mixed. One more forward, please. As you look at, middle of the weeks here, the -3, -4, depending on where you're playing the game, you could be off pretty significantly on a certain week. And you can see that has some real implications into the weeks that follow in terms of how some of that performance was impacted. Again, pricing above the range in 2021 has been a bit of a premium. And I think as you see valuations come down, you see the momentum bid from investors really trying to chase these returns has disappeared, again, because of that poor performance that we've seen in the overall market. What does that mean in the grand scheme of things? It simply means that as you're coming into the IPO market, you need to be extremely confident that the 80, 100, 120 million of overall demand that you identified in your crossover, that you identified from your insiders is really solid. Because a lot of those numbers are continuing to shift down. The investor that told you he may be good for 15 last week, this week he may be only good for 5. And I think a lot of that has to do with risk. A lot of that has to do with moving it towards the end of the year to the context that I just mentioned. I don't necessarily want to be in another position that's quite down, and taking on any new additional positions has become quite challenging. So as we think about where have a lot of these companies gone public, this year I don't think is too much different than the years before. We continue to see a significant number of early stage assets coming forward. The valuations continue to be relatively mixed across the board. Sometimes you get a better valuation as a preclinical company if you're focused on gene editing, for example, than if you're focused on anti-infectives. Sometimes there's a very, very good group of investors that substantiates and kind of pre-validates some of these valuations. So I think the most important thing is to identify a good source of capital through your crossover, make sure there's a number of good investors, make sure that those investors are not just there for the crossover and the IPO, but have deep pockets to think about the follow-on and the transactions that follow, because that's what really the crossover is meant to establish. And as we look at the overall stages of development, still very, very few coming to market in filed or marketed zones. And I think that speaks a lot to, again, the overall M&A targets, and we'll walk through that in a moment. But just to give you guys all a sense in terms of the offer to 1 month and the offer to current, as we think about performance in the IPO space, just to leave that topic on the next slide, you see that 2021 continues to be very, very challenged. Again, that 8% is in the context of a number of companies that unfortunately have broken issue. Still, if you bought every deal, I think you're doing okay. Being up 8%, certainly is not a terrible year relative to being down. Fortunately, I think investors continue to be relatively selective, and sometimes you don't make the right call. Let's switch topics for a little bit and talk about the SPAC market. It's something that has come into the limelight over the last several years, and something that we've been talking about here in our keynote presentations. And again, this is just a pocket of capital that a certain sponsor raises, and then they go shopping for assets. We've been involved in a number of these transactions and have executed a number both in Europe and the US. And I think it's quite interesting to think about 2021 and the percent of issuance being so high in the first 2 months of the year. And you can see absolutely record SPAC issuance. And again, looking into 2020 and 2021, there is a significant amount of capital that has been raised, and very, very little that has been liquidated over the last several years. So all of that money in the bottom right there in 2021, that 97% that's looking for assets, that all is either going to go back to shareholders or go out and shop and identify assets. I just want to remind the folks as we look at the next slide here that there are very, very different sets of SPACs in terms of the ones that raise a significantly greater amount of money. Those continue to perform quite well. By and large, it is a very, very mixed bag, and performance in the healthcare space has been mixed as well. We haven't seen very, very positive performance on the back of an announcement in quite some time. And I think that's impacting the overall market. We've seen a little bit of a slowdown or a significant amount of slowdown, certainly in the healthcare specific SPACs. But in the healthcare market, again, you need to think about the two different types of SPACs that there are. There are those that are funded and exist from the high quality healthcare specialists. And then there are those that are searching for biotech and healthcare assets, but don't necessarily have the same name brand. I think that the PIPE transactions that follow these SPACs in the healthcare specialist realm are challenging today, to say the least. To try to execute a PIPE without a good, high quality validating investor as that sponsor, I think is a very, very difficult transaction. And this, I think, speaks to the point that I was mentioning just a moment ago. If you look at the announcement, you can see all of those situations and the current are all in parentheses. And I think that highlights all of the healthcare SPAC business combinations that have been announced. Unfortunately, they're just not performing immediately right out of the bag. That being said, there are several situations on the back of good data that continue to perform quite well. And I remain relatively enthused that this market is a great new opportunity for the biotech community to have access to greater pools of capital and go public in what would be kind of a shrink-wrapped crossover and IPO in one step. I think as the market continues to get more challenging, this market will continue to be a good option for biotech market. Lastly, let's talk a little bit about M&A and what's happened this year, what's happened over the last several years, and the continuing trends, and then a little bit about partnerships and where folks are going. There continues to be a strong bias for late stage, de-risked marketed assets, certainly on the higher side of the scale, north of 5 billion. That's typically what you are in a marketed scenario. Sobi this year, GW this year, Acceleron, very, very good data. I think those are very, very good examples of situations where the product has been on the market, been relatively de-risked, and now it's an opportunity to incorporate those revenues, establish some synergies, and really focus on the pharmaceutical earnings profile that a lot of these pharmaceutical companies typically do, versus going into kind of a phase 1, phase 2, $3 billion risk profile. On the partnership side, however, on the next slide, we do see earlier stage companies getting more deals. And as you look at 2021, and a number of partnerships that we continue to track, a significant greater portion of them are in that early preclinical phase 1 sense. And I think this is just a function of where the market is and what's existing out there in the market. Folks being a little bit more excited about science and trying to get in early and identify the targets and those early monoclonal antibodies in some cases that are very attractive relative to the targets that they're after. As we think about the year behind us, I can say that, again, it has certainly been a challenge. The last several weeks have seen a number of IPOs pulled. I think the onus is on certainly identifying the right price as you move up the ladder and establish yourself as a pre-IPO company, but really identifying a really diverse group of investors, because as performance continues to get mixed, investors that may have been in the IPO last week, a few weeks forward, they may not be. So looking ahead, I think we've got some interesting opportunities in 2022. Hopefully the reopening of the market will get things back to normal, and the biotech space will equilibrate a little bit. We're seeing quite a bit of pressure. So Josh, let me pause there and see if there's any questions that you or any of the other folks have in the audience.
Thanks, Gil. We've had one question, and not quite on the presentation itself, but on the access to the copy of the presentation. It's not going to be sort of more widely available for distribution, but please do shoot me a message if you would like a copy of that, and then I can pass that on to Gil, who can distribute where appropriate. Quite a lot of some of the data that was, I guess, presented yesterday in the McKinsey report, which I think we were discussing just before we got on, about the sort of IPOs going earlier and earlier, not more preclinical companies listing. And you mentioned maybe some technology areas where that sort of preclinical IPO is more attractive. Maybe you could sort of delve a little bit more into that and dig into a little bit more of, that trend and where you see it most stark, I suppose, in terms of technology or therapeutic area.
So I think, this last year, gene editing continues to be really, really hot. I think that's one area. I think it's also very, very target focused in some cases in terms of what folks feel is the the most interesting slice of bread of the month, so to speak. But in overall, as we think about the market and what investors are really focused on, I think from a preclinical to early stage perspective, the companies that are being very, very successful are those that are establishing the high quality specialist validating investors early on. And that begets a lot of the self-fulfilling prophecy earlier on. And therefore, in terms of financing a platform that can really push a significant amount of products into the clinic very, very quickly, you're seeing a significant amount of capital being thrown at some of these platforms. But again, that really only happens once you validated it very early on. A lot of biotech companies from Europe that I speak to have phase 1, phase 2 data and haven't incorporated a lot of those kind of US style investors into their overall dialogue. And then therefore, it may take them a little bit longer to get those investors excited. But also, the moment that you have data, people start looking for more data versus an overall science project that they can fund. So I think a lot of it also is management. A lot of it is also, comfort in terms of what these investors are looking to put their money behind. But yes, preclinical continues to be an interesting zone. Sometimes I can't understand why one platform goes out at 500 and another one goes out at 350. But again, I think a lot of it is the valuations that's being validated and substantiated by a lot of the insiders that exist in there to begin with and are setting the price at the IPO and are willing to buy the whole deal at that price.
Yeah. Please do keep your questions coming in the chat and Q&A functions, and we can get to them throughout. So I guess maybe again digging in a little bit more into the sort of performance of the sort of biotech index compared to others. You sort of alluded to some of the reasons you thought that was the case, but I guess maybe digging a little bit more into sort of why, relative to some of the other indexes, it's down quite a lot, and then maybe what you expect in through it, future looking into 2022, what you expect the performance of the market to be.
Well, I would hope that January becomes a bit of a clean slate for some investors, right? I think some investors got caught a little bit in the Biogen news. I think that was a big surprise to a lot of folks who anticipated that would not get approved. And I think there have been a number of other, bad news events that have put folks, really on the sidelines in terms of, risk profile. As you move into 2022, theoretically, that's a brand new year and a new clean slate, to make some investments. And I continue to see January and February over the last several years is very, very active. And how those few months perform really kind of sets the tone for the rest of the year. So we anticipate a good amount of backlog in January and February, as a number of the deals that I think are probably teed up to go this week, next week, the following week are probably going to be pushed into 2022, just based on what the market's been telling us. And as those guys go forward, if they perform very, very well off the bat, then we're off to a fairly good start. But, we've seen, in San Francisco, when it rains, sometimes it's a good day, sometimes it's a bad day. I think that overall tone will be quite important in terms of how we set the stage for the rest of the year. And also, a couple of good M&A trades would be really, really helpful to bring some capital back to institutional investors and get them to feel a little more confident in terms of deploying some of that capital.
I think, I guess the sort of huge number of IPOs that have happened on the Nasdaq over the last sort of 18 months or so, we're also seeing a lot more sort of European companies who are making that jump, perhaps than we've ever seen before. It's in terms of the sort of the public markets here in Europe compared to the US, maybe a comment on that. Do you think it's going to be still that well-trodden path to the Nasdaq, or
Good question. Yeah, I think some of the markets function better than others in terms of biotech. I think the Scandinavian markets have a very, very good kind of backdrop of institutional and high net worth individuals that are comfortable investing in biotech. This year's been a challenge for that market, notwithstanding. But I think as you look at the European IPOs, I still believe that they are a stepping stone for a next Nasdaq deal. Over the last 15 years, accessing and helping my clients access capital, at a certain point in time, you really tap out of the European investor base. And while you may be able to get a 35, 40, $50 million deal done with some retail, some high net worth individuals, a couple of good institutional investors in Europe, as you continue to push your products forward, and if they really are, blockbuster opportunities, sometimes that calls for 100, 150 million bucks to write your own ticket, do your own phase 2, and do a real proper study, as opposed to outsourcing to some CRO and some Banana Republic that doesn't really have the same level of ethics or quality in terms of what the data is. You got to cut corners because you don't raise enough money. So to do it all right, I think you got to raise the right amount of money. And I think at the end of the day, to get that valuation, to get the overall capital behind you, and to really create that valuation uplift, I think the NASDAQ remains that key home market. I would love it if the European markets were much more efficient. But again, as I think we've discussed in the past, certain European markets are just not set up for biotechnology companies with discount limitations, with pre-application of rights, which really hamper the amount of money that a European listed company can raise relative to a US company. And I think that's why we've seen since 14, 15, really a significant, more than 50 plus biotech companies accessing the US capital markets. And I think it's really on a hand, I can count the ones that have gone out more recently. But again, I think all of those folks also see that as actually a stepping stone. I will say that the dual listing, taking a company that's already in France or Sweden or the UK and establishing a secondary listing is a much more challenging and difficult transaction to execute than said private company going public in the US. A lot of that has to do with the valuation that you can set, a floating share price, and again, the applications and the regulatory limitations that exist in said market really make it challenging to try to fit the NASDAQ rules on top of French, Danish, Swedish, Spanish, whatever rules you're looking at. So I continue to be encouraged when I see some folks do raise some capital, but by and large, I remain to be pretty focused on the US is the right place for folks if they really want to finance their study in Unlock Valley.
And I guess moving on slightly to that, into the sort of SPAC conversation, obviously been the biggest trend over the last few years, particularly in the last 18 months or so, particularly in biotech. A lot of these sponsors of these SPACs, and I think we're going to hear from some of them later, RTW and EcoR1 and people like that in our panel at 3 o'clock. Do you see a lot any European funds, or I mean, at the moment there's EBAC, but any other European funds you think will be maybe launching their own SPACs as sponsors on the NASDAQ?
So there was, LSP obviously has done one. They're obviously in the news this morning with an interesting transaction with EQT. So congrats to that team. Again, I think they're looking for European assets that go into the US. A lot of the SPACs that we work with, they look broadly across the globe. So, I think that the home of the biotech company needs to be NASDAQ at the end of the day. So, we've thought about a listing in Amsterdam, a listing in France, and attracting biotech companies, but I just don't think that that's, something that's a, really viable option, frankly, in terms of the folks that would access that capital. And really, when you access a SPAC as a biotechnology company, you want to make sure that the investors in the SPAC, the top 20, are the ones that you would have at the end of the day in your IPO. And I think that's what the RTWs, the EcoR1s, the Perceptives, the Bains, the RA Capitals, those SPACs really, like I said, give you that shrink wrap crossover and IPO in one. Maybe you get a blended valuation, but you're raising 450 million or 400 million, when typically in an IPO, you're probably limited in some cases. And again, I think overall performance continues to be a real question. At the end of the day, I think we need to look back 5 years from now and really say, did these work at the end of the day? My prediction is that at the end of the day, it'd be very, very company specific. The companies that access the capital, the companies that perform when their drug works, you'll see those stocks do very, very well. And conversely, those that don't, you'll see them go off 70%. But again, to that point, I think this week, continuing to get to the point of how challenging it's been, just over the last week, we've seen, $500 million partnership with a big pharmaceutical company, positive data in oncology, trades down 50%. The partnership with Pfizer trades down, positive data in a depression study, also down 20%. So, I think that people are very, very picky in terms of the data that they're looking at, and they're always going to ask for more, despite what you told them that you're going to show them. They'll say, well, where's this? Where's that? And, I think it's just constantly reaching for additional data and initial analysis to get comfort.
And you mentioned you think that's going to be an increasingly attractive opportunity for a lot of biotech companies to access the public markets moving forward. So you see this sort of trend continuing? Do you think there'll be more SPACs coming out? I mean, how do you see that sort of the whole SPAC?
I think those that continue to have good track records, I see that continues going forward. I think it'll be less on the healthcare side. But again, also if some of these continue to perform, I think you may see a little bit more of a resurgence there. It's still is a very, very unique instrument to establish liquidity and really raise a significantly greater amount of capital than you normally would. And being involved in, 5 that have been announced, I can tell you that it's certainly not as easy as it was early on, but the investor base that you get immediately and the visibility in terms of accessing investors is very, very similar to what you access into the IPO. And again, as I think we've discussed, the fees are significantly lower than what you typically pay in an IPO relative to what you do in a SPAC.
So we've got a question from Gregory Thorens, hopefully pronouncing it correctly. And he asks, are you aware of any trend differences between therapeutic and diagnostic companies? Are the shorter timelines of diagnostics seen as an advantage? Does one category go faster to IPO than the other?
So diagnostics is not really my space, but I do have a number of partners that do focus in there. My understanding of the space as it is today is, and looking at that, and also high growth med tech as a segment there, I think there's a much greater onus on those management teams to have 30, 40, 50 million of revenue before they're kind of IPO ready and established in commercial sense versus therapeutic companies, which again, you could have a dream and in a box and you could potentially get a significantly greater amount of capital. A lot of that has to do because a lot of the diagnostic investors are very multiple focused and will look at high growth multiples to apply to your overall early stage revenue. And if there is no revenue and there is no commercial piece, it becomes really, really challenging to get those guys on board. There is venture obviously in that space, but from the standpoint of how those valuations are being set and how exciting that market is, I think that's quite challenging. I can tell you that the liquid biopsy space, some of those life science tools providers, has been a very, very hot space. And looking really at proteomic tools and the future really of drug-drug interactions and proteomic analysis is really, I think, from whether it's mass spec or some of the new tools that you see, I think is really going to be quite important in the diagnostic realm. What I am seeing a lot, though, is also a lot of these theranostic approaches, the HER2, Herceptin, where you do a genetic test initially to try to validate and identify a key class of patients that may be susceptible based on a certain marker. And that kind of packaging of a theranostic, and I'm continuing to see a lot more of that, certainly over the last 3 to 4 weeks, actually, as folks look for lower risk or de-risked programs with a little bit more visibility in terms of data.
We sort of come towards the end here. So if you do have any questions that you'd like to put, please do put them in the chat and questions function, and we can try and squeeze them in. I guess moving on to the last thing you sort of discussed there on sort of early stage deals and how that's been rising, more early stage deals. Do you see that as a trend that's going to continue as well? And I guess more widely, I guess I'd ask what's your sort of predictions if you're looking to your crystal ball for 2022 for both deals, but just the wider market in general, if you had to gaze a little to the future.
Listen, I think that the buy side really wants to believe, right? And I think unfortunately sometimes you run these phase 3 studies and they don't work out. Hard to answer your question other than to say if we have some really good data, I think that begets some approvals and that will get folks really excited. I think the issue is that you've seen a number of really, really bad results of late. And I think that puts people, in a little bit of a more risky attitude in terms of jumping into a pre-phase 2, pre-proof of concept zone. That being said, I think these things do go in cycles. And as you get continuous new data, I think you continue to see a number of those M&A transactions continue to come forward. Typically, we see that in January. I think we've seen a consistent flow through. COVID may have paused things a little bit, but I think the overall level of activity, I hope, will continue to move forward as Big Pharma continues to fill its pipeline. And certainly on the earlier stage side of the equation, I think we will continue to see pharma teams looking to outsource their R&D and identify, new assets that, for programs and places that they're actually focused on, right? Trying to bring in those interesting molecules. So we'll see what the hot craze is for 2022. But hopefully, as we get into January and February with a bit of a clean slate, as investors look forward, maybe the overall overselling of the biotech market that may present an opportunity for people to jump back in. We'll get back into that upslope of the cycle. So I think it's been really, really oversold and really over a lot of pressure. And hopefully that mentality switches pretty quickly. it's really just one M&A trade sometimes in San Francisco that you read about that really changes that whole mentality. So hopefully we'll see one of those.
Yeah. And of course, the Investable Showcase here is partnered with the Jefferies Healthcare Conference. So maybe a sort of final word on how everything's going for next week for the Jefferies Healthcare Conference, and maybe what people who are attending, whether that be in person in London or indeed virtually, what they can expect from next week in the Healthcare Conference.
Yeah, I'm relatively encouraged. I think we've got a very, very good, I'd say, primarily European crew. We found that folks around London and continental Europe are much more excited to jump on a plane for an hour or two and come to London and have 2-3 meetings even. Whereas I think the US market, I think maybe a little bit cautious in terms of testing and getting quarantined a week before Thanksgiving. So I can understand. Nevertheless, I think we expect, almost 1,000 participants over the 2 days that are live next Tuesday, Wednesday, and then Thursday, Friday. Will be that kind of hybrid event for folks who are not willing to travel or couldn't go ahead and travel. So it should be a very good event. Looking forward to seeing a lot of folks back in person. I know that over the last several weeks, as things have been getting back to normal, it's really nice to have some human interaction. So hopefully you'll be getting out of the spaceship soon enough.
Excellent. Well, yeah, I want to say a big thank you to Gil for running through the presentation this morning, and of course the full Jefferies team for everything that goes into these reports and deep dives, and indeed the partnership we have with them for the last few years for the Investable Showcase. Very much looking forward to what I'm sure will be a little bit more normal of an event next November. Yeah, big thank you to Gil for this morning. Not the last you'll be hearing from Gil. We do have our 10 o'clock panel focused on risk and reward within the life sciences industry. So that starts in just under half an hour at 10 a.m. GMT. So I hope you'll be able to join us there. But for now, thanks again, Gil. And yeah, I'm sure a lot of people are listening and watching, and look forward to maybe seeing you in person next week as well.
Terrific. Thanks, Josh. Thanks, everyone. See you in a little bit.